Hello, today I want to talk about the CAPE ratio, the cyclically adjusted price to earnings ratio, also called the CAPE ratio, also called the PE10 ratio. All right, so what is this? What we're going to do here is what we want to do is we want to take the current price like we would do with a normal PE ratio, but instead of using current earnings, we want to use the average earnings over the last 10 years and then adjust that for inflation because, of course, inflation is something that is real. So we could also here you can kind of just take the price of the index times the change in the CPI. Same thing last 10 years, average of the last 10 years times the change in the CPI. So that just tells you how to adjust for inflation. It's a pretty simple measure here. Now, for what it's worth, I have 3 videos here on inflation that I think are worth checking out. I have some criticisms with inflation, but namely with the fact that we have changed methodologies over the years, but don't change historical data, which makes time series comparisons impossible. Now, why would people use a cyclically adjusted CAPE or a cyclically adjusted PE versus a regular PE? Well, the idea is that there are business cycles, right? There are good times and there are bad times in the business cycle. There is volatility there. There's also idiosyncratic volatility for a company, and uh, those are volatile over time. Now, what we can do is by using averages, we can kind of smooth that out, gives a better sense of the long-term financial performance and health of a company. So it gives us something a little bit better than a point in time piece of data. Now, the other thing we can do is we can compare the CAPE ratio over time here. So we can see, if it's higher or lower than normal. Now, so what we can do here is we can put in kind of the average. We can see that with the orange line here is kind of the average CAPE ratio over this time period going back to 81. And we can see the standard deviations. Right now, we can see that for the fourth time ever, the CAPE ratio is more than one standard deviation above average. Of course, the big peak during the internet bubble now is kind of the second highest CAPE ratio we've ever seen, which to me seems unusual given the problems we are having in the economy due to the global pandemic. Now, you can check out a number of videos here. These will kind of talk about the disconnect that I don't understand between not only the economy and the stock market, but also the underlying fundamentals of the companies in the stock market and the stock market price valuation levels. It also talks about time series evaluation in one of these videos. So go check those out. They're interesting videos. Now, of course, I can't do this without commenting that I do not like PE ratios for a number of reasons. I have documented those reasons if you follow these videos here. So we should really be using kind of the cyclically adjusted earnings to price ratio as a better ratio because the PE ratio has problems due to its non-linearity. And we can see the distortions in non-linearity. If you look at this internet bubble, you can see that kind of that spread is between the PE and the inverse EP is magnified by the PE ratio there. And you can check out all the kind of the reasons behind that there. But again, check out the CAEP, the cyclically adjusted earnings to price ratio. I think ultimately that is a better measure. So keep that in mind. Next time, I will talk about criticisms of the cyclically adjusted ratio. I told you the benefits in terms of smoothing out and getting a better sense of long-term performance in this video, but next time we'll talk about some other criticisms of it. Thanks so much for listening.